In the mid-1990s, Wall Street was fundamentally changing. The era of the screaming pit trader operating purely on gut instinct was coming to a close. The new gods of finance were not high school dropouts with a killer instinct. They were quantitative analysts. They were PhD mathematicians, physicists, and computer scientists recruited from MIT and Harvard. And in 1994, the ultimate quantitative supergroup was formed. It was a hedge fund called Long-Term Capital Management, or LTCM. It was founded by John Meriwether, the legendary former head of bond trading at Salomon Brothers. But Meriwether didn't just hire smart traders. He built a syndicate of sheer intellectual dominance. His board of directors included David Mullins, the former vice chairman of the Federal Reserve, and more importantly, it included Myron Scholes and Robert Merton. These two men were not just academics, they were the literal inventors of modern financial mathematics. 3 years after joining the fund, Scholes and Merton would be awarded the Nobel Prize in Economics for inventing the formula that prices options. LTCM was not viewed as a standard hedge fund. It was viewed as an academic certainty. When Meriwether went to raise capital, he didn't pitch a strategy. He pitched a mathematical law. The fund promised to remove the chaos of human emotion from the market entirely. They had built proprietary algorithms that could identify microscopic inefficiencies in the global bond market. Wall Street was utterly mesmerized. The major investment banks did not just invest their money into LTCM, they threw it at them. The fund launched with over $1 billion in capital, an astronomical sum for the time. Welcome to Case 022. Today, we open the file on the genius trap and the collapse of long-term capital management. We will investigate the fatal flaw of the bell curve, the terrifying reality of extreme leverage, and the ultimate parable of why a perfect mathematical model will always be shattered by the unpredictable chaos of human panic. The core strategy of LTCM was brilliant in its simplicity, but terrifying in its execution. It was known as convergence arbitrage. The strategy worked like this. The global bond market is massive and complex. Occasionally, two bonds that are nearly identical will drift slightly apart in price due to temporary market inefficiencies. For example, a 30-year Treasury bond issued in February might trade at a fraction of a percent differently than a 30-year bond issued in May, even though they represent the exact same risk. The Nobel laureates at LTCM built computer models that constantly scanned the global markets for these tiny discrepancies. When the model found a discrepancy, LTCM would execute a massive trade. They would buy the cheaper bond and short sell the more expensive bond. They didn't care if the overall stock market went up or down. They didn't care about interest rates or corporate earnings. The only thing they cared about was the mathematical certainty that, eventually, the prices of those two identical bonds had to converge back together. When the prices snapped back into alignment, LTCM closed the trade and pocketed the difference. It was a flawless, market-neutral strategy. But there was one massive problem. The price discrepancies they were finding were incredibly small. We are talking about fractions of a penny on the dollar. A famous Wall Street saying described their strategy perfectly. Long-term capital management was picking up nickels in front of a steamroller. To make billions of dollars from microscopic price differences, you cannot trade with your own money. You need leverage. You need to borrow vast, unfathomable amounts of cash. Because the founders of LTCM were Nobel laureates and former Federal Reserve vice chairmen, the standard rules of Wall Street did not apply to them. Normally, if a hedge fund wants to borrow money to increase their trading size, the bank demands collateral and charges a premium. But the banks looked at LTCM and saw a risk-free money printer. The models were considered so perfect that the major banks, like Bear Stearns and Merrill Lynch, gave LTCM effectively unlimited credit lines with zero initial margin required. The hedge fund strapped their flawless algorithm to a colossal leverage engine. For every $1 of actual investor capital they possessed, LTCM borrowed roughly $30 from the banks. At its peak, the fund had less than $5 billion in actual equity, but they were controlling over $125 billion in assets. Furthermore, they had entered into derivative contracts, complex financial swaps, with a total notional value of over $1 trillion. For 4 years, the machine worked perfectly. The fund generated massive, uninterrupted returns of over 40% a year. The founders were hailed as the undisputed masters of the universe. They had conquered the market. But their entire empire was built on a single, fatal mathematical assumption. The quantitative models built by the Nobel laureates relied on standard deviation. They assumed that the financial markets operated on a normal distribution, commonly known as a bell curve. In a standard bell curve, extreme events that fall 3 or 4 standard deviations away from the average, are considered statistically impossible. According to the LTCM models, a catastrophic market failure that would simultaneously blow up all of their trades would only happen once every billion years. But financial markets are not driven by the laws of physics. They are driven by human beings. And human beings are prone to sudden, violent, irrational panic. In quantitative finance, this flaw in the bell curve is called a fat tail. It means that extreme, seemingly impossible events happen far more frequently than the mathematical models predict. In August of 1998, a fat tail event detonated in the global economy. The government of Russia, crippled by falling oil prices and internal economic chaos, did the unthinkable. They entirely defaulted on their sovereign debt. A global superpower simply announced they were not going to pay their bonds back. The statistical models at LTCM never accounted for a major nation defaulting in the modern era. The global financial system instantly went into shock. Investors around the world panicked. They liquidated everything. They engaged in a massive flight to quality, selling all of their risky assets and fleeing into the absolute safety of United States Treasury bonds. The flight to quality completely shattered LTCM's strategy. Remember, LTCM was betting that the prices of abnormal bonds and normal bonds would converge. But in a global panic, investors don't care about tiny, rational price differences. They only care about survival. Instead of converging, the price spreads violently ripped apart. The cheap bonds that LTCM owned plummeted in value because no one wanted them. The expensive, safe bonds that LTCM had shorted skyrocketed in value because everyone was buying them. The steamroller had finally arrived. Because LTCM was leveraged at 30 to 1, every single penny the market moved against them resulted in a loss of tens of millions of dollars. Within days, the fund was bleeding $500 million a week. The brilliant founders commanded their computers to liquidate their positions to stop the bleeding. But they hit a terrifying reality. Because they had borrowed so much money and taken such massive positions, they could not exit the trades. They were too big. When they tried to sell, there were no buyers. LTCM was not just participating in the market, they had become the market, and they were completely trapped. By September, the fund had lost over 90% of its capital. The greatest collection of mathematical genius ever assembled was officially bankrupt. But the nightmare was just beginning. LTCM was not going to die alone. Because the major Wall Street banks had given the fund unlimited credit and engaged in $1 trillion worth of derivative swaps with them, the collapse of LTCM threatened to trigger a chain reaction. If LTCM defaulted, the banks would have to absorb the massive losses. This would force the banks to liquidate their own assets, which would crash the global stock market, potentially causing a worldwide depression. Just like the East India Company 2 centuries prior, a single corporate entity had taken the entire global financial system hostage. The Federal Reserve Bank of New York realized the catastrophic danger. They summoned the heads of all the major Wall Street banks, Goldman Sachs, Morgan Stanley, J.P. Morgan, and others into a locked room. The Federal Reserve told the banks that they had created this monster by lending it unlimited money, and now they had to kill it themselves. The government orchestrated a massive $3.6 billion private bailout. The banks were forced to inject their own capital into LTCM, taking over the fund just to slowly unwind its massive trades and prevent a global financial meltdown. John Merriweather and the Nobel laureates were stripped of their control, and the fund was quietly dismantled over the next 2 years. The collapse of long-term capital management is the ultimate parable about the limits of quantitative certainty. When you build your market scanners and backtest your Python algorithms, you will inevitably look at your historical data and believe you have found a flawless pattern. You will see a strategy that has worked perfectly for 5 years, and the temptation to apply maximum leverage will be overwhelming. But you must remember the Nobel Syndicate. A mathematical model is only as good as its fundamental assumptions. If your algorithm assumes that the market is rational, and it relies on standard deviations to measure risk, you are building a glass house on a fault line. You cannot model human panic. When a black swan event occurs, liquidity completely evaporates. Correlations go to 1, and the statistical certainties of the bell curve are violently shredded. Leverage does not create alpha. It only accelerates destiny. And, on the financial battleground, a perfect equation is absolutely useless if you forget the most important rule of the game. The market can remain irrational far longer than you can remain solvent. This closes case file 022.